So as I mentioned earlier this morning, 10 a.m. to be exact, Bank of Canada made their interest rate announcement. They decided to raise another quarter point. Not a big surprise. Many of us were expecting them to raise. I actually thought that it would be kind of difficult just for them to raise once without raising again. They paused for a few months earlier this year, and to then raise one time last month without perhaps raising a second time, I thought was a little bit far-fetched. I figured that they would definitely raise a second time, and they indicated to us that they would do just that. They also indicated at their press conference when Tiff Macklem spoke during his press conference that if need be, he could see the Bank of Canada raising rates once again. And I take issue with this. I really do. And I said it earlier this morning. I was fortunate enough to be on CP24 talking a bit about the interest rates and interest rates rising. I think central banks are kind of taking this approach that they're going to continue to raise rates until something breaks. Now, for me, I think a lot has broken, especially in the US. We saw 3 bank failures in the US. We know that there are a lot of banks perhaps teetering on some issues in the US, some of them obviously regional banks or smaller banks, but we definitely started to see some cracks in the armor. We're also starting to see some cracks in the armor here. I'm hearing more and more from individual investors telling me how it's more difficult to make their mortgage payments. I know a lot of you that have a mortgage have already received letters from your banks saying that the payments that you make every month have to go up because the payments that you were making no longer cover the interest alone. Back when you first took out your mortgage, you would make payments that would cover the interest plus principal. Well, now for many people, what you're paying is just covering the interest. And recently, that interest payment has gone beyond or above what you're paying. And so many of us have had to increase our mortgage payments. So we're definitely starting to see the cracks in the armor. And the Bank of Canada and Federal Reserve, for that matter, as I say often on this show and my radio show that happens every couple of weeks on News Talk Radio, is that these central banks want demand to slow. And how are they going to get demand to slow? By using a blunt instrument, and that would be raising interest rates. They would love to see the unemployment rate tick a little bit higher. That would mean people will have less money in their pocket to be able to spend on goods, which, as we know, can drive up the prices and increase inflation. So I sit here and I think, well, the central banks have a dual mandate. That is full employment and price stability. Right now, it just seems like the Bank of Canada is focusing on the price stability, the inflation part. They're okay with perhaps a slightly higher unemployment rate. They've said that. The Federal Reserve has said that they wouldn't mind seeing an unemployment rate tick higher to above 4%. Right now, they sit at around 3.7. So why are they just focusing on one part of the mandate and not the other? I understand that what they're hearing is that people just can't afford these higher prices. We know that hotel prices have gone up 14% year over year. Food prices have gone up 9% year over year. But I say, well, that's very difficult, and I understand that. But if people lose their jobs, it doesn't matter how much prices come down, they won't be able to afford it anyways. So why would you want, or why would the central banks want unemployment to rise so that demand can fall, so that people can now afford cheaper pricing? If you lose your job, it won't matter what the pricing is. You won't be able to afford it anyways. So I disagree with that idea or notion that we need to see a higher unemployment rate to get the inflation rate down. Look what we've done so far. We've brought down the inflation rate in Canada from 8% to 3.4%. In the US, they went from over 9% to a reading of 3% they announced this morning. And employment has stayed strong. But all I keep hearing is that the market is too strong, the economy is too strong, and therefore we need to raise interest rates. Well, last I checked, you don't raise interest rates just because an economy is strong. And in fact, I believe a strong economy is a good thing. I think we all do. I think job creation is a good thing. Having people spending money, retail sales numbers going higher is a good thing. And over time, we will see inflation continue to fall closer to the central bank's mandate of 2%. But I leave you with this. Is 2%, should that really be the inflation rate? I think a 3% inflation rate with people having jobs, I think is just fine. And I think if we can get there, I think that's where central banks should sort of say, okay, we're in that 2.5%, 3% rate level. And I think we need to just take a longer term approach and maybe have some patience. Have patience as we continue to see inflation fall. Now, I have a few charts that I wanted to show about inflation and inflation rates around the world. The first one we can show is up to date now. We just updated it before we came on the air. And it shows all the countries or areas, many areas in the world. And you will see here where Canada ranks, 3.4% inflation, US down to 3%. We can see Brazil just under 4%, which I think would surprise people, surprise me. You go over to Asia, you see places like Turkey, 40% inflation, which is outrageous. Even China is showing very little inflation right now. So we're definitely seeing inflation fall all over the world, obviously, except for a few countries where inflation remains stubbornly high, but overall inflation is coming down. The next chart I will show is a chart about the G7, right? These are the Western countries, G7. You can see all the countries to the right, UK, Italy, Germany, France, US, Canada, and Japan. And you can see where we rank in terms of inflation based on the other G7 countries. And you can see we are one of the best with respect to inflation, yet we continue to raise interest rates and aggressively. I just don't get it. And then I guess our last chart that we have regarding inflation and interest rates is the Bank of Canada rate hikes chart. You can see here with the most recent increase of 25 basis points, you can see that we're now up to a 5% rate. So the Bank of Canada rate is now 5%. Inflation is only 3.4. So you're looking at a Bank of Canada rate almost 50% higher than the inflation rate, the headline inflation rate. And the core rate is somewhere around 4.4% after you strip out energy. So overall, I get it. I understand Bank of Canada is looking at the core inflation rate, but the headline rate is now 3.4. We're going to get inflation data towards the end of this month. If we see a 2 handle on that, I think it's going to be very difficult for the Bank of Canada to continue to raise interest rates while we see the headline number coming down below 3%, the core inflation rate coming down perhaps below 4%. And I just think it's going to be difficult for them to continue to raise rates. So as investors, my main message is today, hang in there. I think rates or these rate increases will subside. I think we're much closer to the end. I know Tiff Macklin said today that we're definitely closer to the end of these rate increases than the beginning, obviously. And I know for everybody out there that is concerned about their mortgages, their lines of credit going up, hang in there. Obviously, times are a little bit more difficult. Businesses, it's finding a little more difficult to borrow money to grow. People are finding it more difficult to borrow money to buy a house, etc. But as I said, I think we're closer to the end than the beginning. And hopefully, these central banks will focus on the positive and the fact that inflation has come down so much already. And if they just have some patience, they'll see their 2 to 3% target reached in the not so distant future.